Hello, welcome to Chapter 7. We're going to talk about receivables. So, in Chapter 6, we covered cash. In Chapter 5, we talked about merchandise inventory. And this chapter will conclude our discussion of main items among current assets. So, most of the chapter will cover accounts receivable, probably I would say about 75% of the chapter. And then we will briefly talk about notes receivable. I will record two parts of the video. The first part will cover all information up to this aging of receivables method, and then the second video will cover the rest of the chapter. Okay, so let's define accounts receivables. I know you're already familiar with them. So receivables is the third most liquid asset. The first one is cash and cash equivalents. The second one is short-term investments. The definition, there are two definitions right here. It's our monetary claims against others, or it's the right to receive cash in the future from the current transaction. So most of the receivables arise from us performing a service on account or making a sale on account, selling merchandise on account. So we usually debit the receivables. And guys, we have to start getting used to actually listing the name of the customer after the AR, and we credit sales or service revenue account. For notes receivable, there are many different types of transaction. This is one of the popular ones when we lend money. Imagine you're a bank and you're giving a loan out. To a bank, it's a note receivable debit, and you give out cash. You loan money to another company or another party. Types of receivables. So we make sales, and these amounts due from customers for credit sales, they could be called trade receivables. I want you to think of accounts receivables as a one large control account in the ledger. In reality, most companies also have an additional or so-called subsidiary ledger just for AR. So often people might work just in the accounts receivable department. That's all they do. They just manage accounts receivable. So every customer has a separate accounts receivable account. Like, think that you are a customer for PG&E or you're a customer for your college, and your account is a subsidiary account within the AR control account. So control account summarizes everything, but then there are smaller specific accounts within accounts receivable for every customer. So usually these are short-term extensions. We do not charge interest. It's usually 30 to 60 days, and as I said, there is no interest if paid on time. Notes receivables, on the other hand, are used for larger amounts, longer period of time, for riskier customers. Customers or the customers that do not have good credit. And guys, you actually have a note that the borrower signs or issues, and therefore notes receivable are they're easier enforceable in court, and then they usually will bear interest. So we will usually have to calculate interest. We will have the principal, which is the amount borrowed, and the maturity or due date. So here's an example. We made a sale, credit sale, and then later we collected on account. So we are TechCom. Our customer is Comp Store. So this is a credit sale. We debit AR and the name of the credit customer, credit sales, and then we collect on the same day. Looks like we collected 720, and not the full amount. So when we collect, we debit cash and we credit decrease accounts receivables. Guys, by the way, here we omit the entry to debit cost of goods sold and merchandise inventory because we just focus on the sales side. So here how the control account looks like. So this is the main control account. So we put everything here. This is the total balance, but it's not enough information for the business. Now, you will not have to actually do it in your homework. Just be aware that, it's not enough to know that 3,230 is owed to us. So we have to maintain the accounts receivable subsidiary ledger where we have a separate account for every customer. So here we assume we have only two customers, RD Electronics. So you can see that they owed us 1,000, then they paid 720, so their balance is 280, and comp store, their balance was 2,000 and they made another purchase, so their final balance is 2,950, and then we prepare the schedule of AR. Again, you will not have to do it, but so that you're aware, the schedule of accounts receivable, or if you're using QuickBooks, it prepares it for you. It just lists all your credit customers, the amount they owe to you at the end of the month, and when you add them up, you compare this total against the control account, and they have to be the same. Credit card sales, of course, we would prefer not to accept credit cards because credit cards usually charge us between 2 and 8% for service. So that's why sometimes you see, especially like gas stations, they have different price if you pay cash. It's cheaper because they save money on that credit card processing fee. But because competitors all accept credit cards, most of the businesses accept credit cards. Now, we will not talk a lot about credit cards. This is the only transaction you need to know. We will assume here that if the customer uses the credit card company, the issuing company, will pay us cash right away on the same day. So if the customer uses the bank credit card, not the store card, like Macy's card, used at Macy, that's a different story. But if they use, Wells Fargo, Visa, we will assume that we will collect cash no matter what, same day. So when the customer uses the credit card, so for example, here the customer, TechCom has $100 of credit card sales and we have to pay 4%, which means that we will receive cash. You see, we do not even debit accounts receivable because cash is paid right away. But instead of $100, we are going to collect $96, and $4, which is 4%, goes to this new account called credit card expense. And we credit sales for $100. Now, I think it makes sense, so I'm going to skip this quick study 7-1. You can take a look at it. It's just, this type of transaction is done. Okay, now we're going to talk specifically about accounts receivable. There is a big problem that we have to address is that we know that part of the receivables will be bad debt. We just have to assume it. It's risky. It's the expense of doing business. That's why we prefer cash. But to stay competitive and to attract customers, we give credit, right? But we have to assume that we will not be able to collect 100% of receivables. So the issue is then, we make a sale today during this period, but the bad debt amount we will not know about until later, sometimes until next accounting period. But that's an expense that has to be matched to the current period. Remember, one of the main principles of accounting is called matching principle. We have to match revenues and related expenses. That way my net income is reported correctly. So they have to be matched at the same time. So the issue is that we we actually must estimate bad debt in advance. And we have to record it before we close our books for the current period. That way that bad debt expense that's in your account, bad debt expense, will be reported against current revenue today. And therefore, we will follow the matching principle of GAAP. However, the first method that we described here is called the direct write-off method. This method does not follow GAAP rules. It cannot be used by companies following GAAP. It only could be used by very small mom and pop shops because here we break the matching principle and we directly write off bad debt whenever it happens, which often happens next period. So we make a credit sale now, report it now, but we do not estimate bad debt, and we wait until the customer fails to pay, which often happens in the next period, and then we record bad debt expense then. Again, this method is not allowed by GAAP. You can forget about using it, but your textbook covers it. It's a general rule to talk about direct write-off. So main thing to remember, there is no adjusting entry at the end. When you use direct write-off, there is no adjusting journal entry. There is no account allowance for doubtful account. This is in your account we will be using. But if you're using direct write-off, there is no allowance for doubtful accounts, which is in your account. There is no ADA. Okay, so we will cover direct write-off first, and then we will talk about allowance method. So the allowance method is good. We're using it when we use GAAP. Direct write-off is for companies that do not follow GAAP. And also, guys, direct write-off is used for taxation, for tax purposes. Remember, I told you every business actually has to have two sets of books. Every public corporation, the one for financial reporting and the ones for the IRS. So the direct write-off is used for the IRS. So I talked about direct write-off, right? Here it says it's less preferable of the two methods. GAAP says you can use it only if immaterial. Just, I'm simplifying it. Don't use it. You cannot use it because we do not attempt to predict bad debt expense, and therefore we break the matching principle. So as a result, usually our assets are too high. If we use the direct write-off, our accounts receivable impact assets and they're too high, and my expenses are not matched with revenues. So there is no adjustment. Here I had a sale in December, right? We recorded the sale. In January, this customer, J. Kent, cannot pay me $520. So this is what I make. This is direct write-off. This is my journal entry. I debit bad debt expense. Expenses go up. I credit receivables. It doesn't mean I'm not trying to pursue J. Kent. I'm just taking it off my books for now. I'm still trying to collect it from J. Kent. So guys, again, look right here. The sale was recorded and reported last year, December, but the related expense is going to be reported in the next year, and that's incorrect. That is not in accordance with the GAAP. Now, recovering the bad debt. So in January, we took it off our books, but we pursued J. Kent, and then guys, on March 11th, we were able to actually collect the entire $520. So what we're going to do, we have to make, when we recover bad debt, we have to make two entries. We reinstate AR and we decrease bad debt expense. So this is a reversal of my January entry, and then we collect cash. So you reinstate AR and then you collect cash on it. Okay. So this should make sense. And now let's focus on the main method we're going to be using. So that's what's going to be mostly on your test, in your homework. Very little about the direct write-off and a lot about the allowance method, because this method follows the matching principle. We love it. It's GAAP approved. And guys, we are matching and recording the sales revenue and the bad debt expense in the same period. So under the allowance method, at the end of each accounting cycle, whatever it is, every month, so every quarter, every year, we make an estimate. And when we make an estimate, we have to be very careful here as auditors so that the companies do not cook their books. Anytime you can see an estimate, that means that there is an opportunity to make unethical decisions. So we estimate total future bad debt that we will expect in the future period. Usually we base this estimate on the historical data from our past performance, and it will always be given to you, but it's a management decision to make this estimate. So these are two advantages of the allowance method, and it says here preferred. It's actually required, we can say, by both the GAAP and international standards. So here is an example. We have credit sales of $300,000. At the end of the first year, $20,000 of credit sales remains uncollected. Based on the experience of similar businesses, we estimate that out of this $20,000, $1,500 will not be collected. Guys, usually you will be given a percentage, but here they give you the amount, guys, and we have to make an adjustment. This is an adjusting journal entry. It's all about this adjusting journal entry. Remember, under the direct write-off method, we didn't make this adjustment. We didn't have it. But here we have to make an adjustment at the end of the period. Your accounts will always be the same for the adjustment. They will not change. But how we're going to calculate the amounts will change. So what's the adjustment? You're always going to debit the expense, and now it's reported in the same period before we close the books in which we experienced the credit sale. And we credit this new account, ADA. Guys, look at this account, Allowance for Doubtful Accounts. It's a contra asset. I want to show it to you. This is a T account, Allowance for Doubtful Accounts. It's a contra asset. Just contra asset. It's an account that it's a permanent account, it's an asset, it's listed among assets, but it has the opposite signs, minus, plus. So it will always have a beginning balance. And guys, it just happens that sometimes the beginning balance will be on the credit side, positive side, sometimes it will be on the debit side. It just happens that way. So the problem will always tell you where it is, and this account is really the opposite of AR. It's really the opposite of accounts receivables. So if I want to know what my collections will be, what my net AR is, it's going to be accounts receivable minus allowance for doubtful accounts. They will be listed like that on the balance sheet. AR less ADA gives me net AR, and it would be here $18,500. So as an investor, I will see not the total AR, but I will see net amount, or so-called net realizable amount. Even though customers owe the business $20,000, the business believes it will collect only $18,500. Okay, I'm moving forward here. So here it is, right? It's listed among current assets on the balance sheet. This is how it could be listed, AR minus ADA. This is the net realizable amount. Or most of the time you will see that businesses are not going, just to make it shorter, they will just say net of doubtful accounts, just like this. They already list the net amount, net realizable amount, or net realizable value. Here we go, right? Asset and contra asset. Okay, how do we write off bad debt? Guys, in December, I made an estimate. I did not know who will not pay me. I didn't know who I will not collect from. I believe in total, I will not collect $1,500, right? Now, January rolls in, and when I start actually not collecting from specific customers, what I'm going to do, I'm not going to impact the expense account anymore. I'm going to decrease debit ADA and decrease credit AR. So ADA is like a piggy bank. I estimate that my bad debt will be $1,500, and when I actually don't collect, I will debit this account, and this balance will decrease. So if I overestimated my bad debt, ADA will have a credit balance. If I underestimated, so in reality, let's say I don't collect $1,600. So I will debit $1,600. So if I underestimated, then at the end of the period, ADA will have a debit or negative balance. So look what happens here. We actually know that JCAN cannot pay us $520. So we debit ADA, we credit AR. No expense, right? There are no expenses impacted. So look how ADA looks like. It's a permanent account, right? I thought $1,500 will not be collected, and then in reality, in January, I did not collect $520. Debit ADA, credit AR, both accounts are decreased. So the write-off does not affect the realizable value of accounts receivable. This is very interesting mathematically. Guys, 20,000 minus 1,500 would be the same as when you subtract 520 from both. When I decrease both accounts, the difference between them does not change. The difference between them, look, I wrote off 520, so AR went down and ADA went down, but the difference between them is the same. So my writing off of bad debt does not have any impact on the net AR, on net realizable value. Make sure you understand that. And then later we might, again, recover the bad debt, and we do the same. We here what we did before. We flip the previous transaction. In March now, Ken will pay us $520. So we flip the previous transaction, right? This transaction is flipped over. I debit AR, I credit ADA, and then we collect cash. Most of the time, you only will be asked to do the journal entry adjustment, the adjustment. Most of the time, you will just be asked to do only this entry in most of the homework and tests, not what happens in the next period. Okay, so now how do I apply this allowance method, right? So to use the allowance method, you can use either percent of sales or percent of AR. It doesn't matter, both of them are acceptable by GAAP. Percent of sales is easier, but not as exact. And percent of receivables is a little harder, but more exact. In my experience, companies usually use percentage of sales for their quarterly statements, but they will use the percent of receivables, actually aging of receivables, for their annual financial statements. Now, the problem will tell you which one to use, percent of sales or percent of receivables. So percent of sales is very easy. You take the sales, either total sales or only credit sales, whatever the problem tells you, and you will be given the percentage of bad debt, which the company estimates. You multiply and you plug it in. This amount that you calculate, you debit what? Debit bad debt expense, credit ADA. When do you make this transaction? The end of the period, December 31st. That's your adjustment. So here's an example. We have credit sales of 400,000. Our estimated amount is 0.6% of credit sales will be uncollectible. So we're going to adjust on December 31st. What do? We just simply multiply credit sales. Now, you might be given receivables, you might be given balance of ADA. You don't care about other facts. You just calculate 0.6% on the amount of credit sales, 2,400, plug it in. Plug it in, plug it in. So you directly plug it in. It's only one step. When you use percent of sales method, there is one step. You calculate, you plug it in. So it's very simple. Now, the account receivable method has two steps. You will be given the percentage now of AR that you think will not be collectible. So you take AR, multiply by the percent. That's the first step. And you cannot plug it in. The amount that you calculate is the desirable balance of ADA after the adjustment. So you need to look at what's my existing current or beginning balance of ADA, right? And then you have to figure out what to do with ADA, how to adjust it to get to this amount. So there are two steps. It's a little bit more complicated. Let me show you an example. So my Musicland has 50,000 AR, 200 credit balance of ADA. We need to know that. And it's a credit balance. Again, sometimes it will say here debit balance, right? This example lists credit balance in ADA, right? Past experience suggests that 5% of receivables are uncollectible. So first step, calculate 5% on 50,000. This is not an adjustment. This is just the first step. I want my ADA to be 2,500. This is what that amount means, right? But my ADA already has a balance of 200. You see this? 200. So what do I need to do? I need to subtract the two. This is what the slide talked about. Total estimated bad debt expense minus previous balance. So if it's a credit balance and my credit balance was 200, but I want the balance to become 2,500, how much do I need to adjust ADA? 2,300, which is 25 minus 200. So what's my adjustment? 2,300 bad debt expense debit, ADA credit. So after you adjust by 2,300, what is the balance going to be? 2,500. So again, percent of receivables shows to you what you want the ending balance of ADA to be. Now, if your beginning balance was debit, you would need to add both of those amounts. So if your beginning balance is credit, you subtract them. If the beginning balance is debit, you add them. I will demonstrate with examples. Okay, so quick study 7-6, page 343. Let's do quick study 7-7 first. So let me go to quick study 7-7, right? Percent of sales method, okay? And guys, here we go. Percent of sales method. Warner companies Unadjusted trial balance shows AR of 99,000. I don't care. When I use percent of sales, I don't need AR. ADA balance 600. I don't care. If I use percent of sales, I don't care about. I ignore the beginning balance. And sales 280,000. So that's the only one I need. So I have 280,000 of sales, and they tell me that 0.5%, so multiply by 0.005. So that's the amount I will not collect. What do? One step. I debit bad debt expense. I credit ADA. Guys, again, it doesn't matter if I use percent of sales or percent of receivables. The accounts are the same. It's just that the way I calculate the amount is different. 1,400, I'm done. Guys, percent of sales is easier, but as you see, in reality, what is your ADA going to be? I adjusted it by 1,400, I ignored the beginning balance, so now my balance is actually 2,000, right? So this method is easier, percent of sales, but it's not as specific as the percent of receivables. So let's go to quick study 7-6, and there's actually two components to it. But right here, they just give us one component. So I'll do instruction 1 and I'll do instruction 2 separately. So same information, but now we have to use percent of receivables. So I'm going to, again, use the same accounts. Bad debt expense, allowance for that. By the way, this could be called differently depending on the business, but this is what we're using. Now let's figure out the amount, right? So let's figure out here. Percent of receivables. My receivables are $99,000, and I'm going to multiply it by 1.5% or 0.015. Okay, 1485. Let me show you T account. So I want this balance to be 1485. But I need to take in consideration what the beginning balance of ADA is, and it's $600 credit. So this is the beginning balance, right? Beginning balance, and this is the ending balance I want to have. So the question is, how much do I adjust, right? So what is my adjusting journal entry should be? And guys, since they are on the same side, you subtract them. You take 1485 minus $600. That's the amount of the adjustment, 885. So you just subtracted the two. So when you use percent of receivables, it's a two-step process. So bad debt expense debit 885, ADA credit 885. So look, this is a more precise method because what do I want my bad debt allowance to be? 1485. I adjust it by 885, and after this adjustment, I get the ending balance. That's how it's going to be reported on the balance sheet. So that's a better method. Okay, the second part, let me go to the textbook. So quick study 7-6. The second part says, what amount would have been used in the year-end adjusting entry if everything is the same, but the allowance account had a year-end unadjusted debit balance? So instead of the credit balance of 600, what would happen if we had a debit balance right here? So beginning balance would be 300. And again, why would it happen? Because, you know, we would have a debit balance if the company underestimated in the previous period. So what would my adjustment be? So I would have to add these two together now. I have to add them together. So that would be the answer. So 1785 would be the adjustment. Debit bad debt expense, credit allowance for doubtful accounts. So I'm going to stop here, and I will continue with the aging method, which is a continuation of the percent of receivables in the next video. Thank you so much.